Stocks have been lower over the past week, down about 3.5%. My next guest says traders are looking for short-term profit, or traders looking for short-term profit should avoid issues for the next week or two. He's got a lot more to say, though, than that. Michael Shaoul is the chairman at Marketfield Asset Management. His flagship fund was up over 14% last year, beating 90% of his peers. He oversees $1 billion. Also with me at the CME is Dominic Chu, who I'm sure would like to be here in the studio with you, Michael, to talk more about the markets. But we've got Dom there at the CME. He's going to be joining in just a moment. But let me just ask you first. Does it seem like we're bottoming here, or does it seem like we may be headed for another bear market?
I don't think the U.S. is heading for another bear market. We continue to view this as a correction, a multi-month correction in the middle of a longer bull market.
Longer bull market, okay.
I don't know whether you've seen the ultimate low for this particular correction. You certainly saw the kind of sort of panic and across-the-board liquidation that you see at a short-term low a couple of days ago. But, this sort of negative behavior, once it takes hold, can stick around for a few weeks.
So would you be a buyer here then, Michael, or would you wait a little bit?
We'd be a selective buyer at these levels. There are certain sectors which have hung in much better than the overall market and where the news continues to be okay.
But, Michael, why do you think all this talk about, and I don't want to put words in your mouth, but all this talk about, a double-dip recession, right? And we've had, horrible revision in the first quarter GDP.
Yep.
Why don't you think that that's actually indicating something worse here?
Well, if you look at the U.S. economy, I think in this particular cycle, it really starts at the level of the retail consumer. What you have is still, very moderate inventory levels in terms of actual goods. And therefore, if retail sales continue to appreciate and continue to increase, it's very difficult to see the internal industrial economy falling apart. And
no, go ahead.
And retail sales numbers, look good. We just had the official July numbers coming from the actual stores themselves.
Yeah, better than expected on the most part.
Yeah, and really pretty decent. So, until and unless we see the retail consumer turn turtle in the way that a lot of people have been expecting, we're going to remain constructive about this cycle.
Michael, I want to just drill down into sectors. I want to talk about financials, because we had Tom Brown on yesterday, and I just want to roll for you what Tom said, because he sees a rally coming in financial shares.
We're going to be based on these almost daily economic numbers that come out, right? So we've had some pretty good housing numbers in the last month. And if you can see that trend, that would be a huge impact on the market. If you get better employment numbers, the weekly unemployment claims continuing to come down, keep them below 400,000. If we can get the payroll number this Friday to be a positive surprise, all these things could begin to change psychology.
So, his take is that if the macro picture improves, then the financials will participate in that. But that's something different than what you believe, right?
Yeah, I agree with everything he said, apart from that therefore makes you want to go and buy the financial sector. The financial sector in this particular cycle has two massive issues. One is its overhang from the mistakes it made in the last cycle. And the other massive issue is that regulatory pressures have made it significantly less profitable to be a large financial corporation.
So you see declines?
Well, I certainly see a failure to participate in upside. Whether we go further lower from here, I'm more open-minded about. But I don't see financials as outperforming the market.
As something you need to be in. Okay,
No,
Dom, jump in.
Yeah, I was going to say, I was talking to Kevin Craney over at RGO Futures. He was talking about some of their clients, some of their bigger net worth, higher net worth clients, saying that they really are in risk aversion mode right now. The mentality being, Michael, that they don't mind missing out on some of the upside as long as they don't have the downside there. Are you feeling that same kind of psychology among your clients, among the people that you talk to right now? And if that's the case, should people really be buying this dip if they can't afford the risk?
The short answer is yes. I think that people have switched from wondering why you're not participating in a 5 to 10% up market to wondering why you would ever want to own an equity again. And it's not the first time since 2009 that you've seen this massive switch in psychology. My feeling is that the only way to invest in this very volatile short-term environment is to have some conviction in what you're doing, and we believe that there's some long-term positive trends in place in multiple sectors in the United States.
Michael, thank you. Great to have you stop by again.